What's up, you guys? Welcome back to the Average Joe on Money Financial channel, and in this video we are talking about Vanguard, but more specifically we're talking about Vanguard Index Funds, the Vanguard platform, and how you can invest in Vanguard Index Funds for 2021. If you've watched my channel at all in the past, you know that I'm a big fan of index funds and the products that Vanguard offers to its investors. Vanguard has a unique platform, a unique value proposition, and in this video I want to share with you exactly why Vanguard is different than every other investing brokerage out there. We're going to talk about what different accounts they offer. We're going to talk about the differences between Vanguard mutual funds, indexed mutual funds, and Vanguard ETFs. We'll talk about Vanguard target funds. We'll talk about how these funds have performed in the past year despite COVID-19 happening. And we'll talk about, lastly, a recommendation for you moving forward, depending on your unique circumstances, depending on, how close you are to retirement. We're going to talk about what types of investing products Vanguard offers that might be a perfect fit for your portfolio. So if you need to pause this video, go grab something to drink, sit down, get comfortable, and let's talk about Vanguard and how it can make your life better. All right, guys, so we're here on Vanguard's investing platform. This is the landing page you're gonna see when you come on Vanguard's website. And first thing I wanna talk to you about is Vanguard as a whole. Truth be told, there are a lot of different investing brokerages and products that you can utilize to improve your life financially. So why would you choose Vanguard? Well, Vanguard is unique because they were the original investment company for the average Joe out there. Back in the day, it was very difficult for the average Joe to invest for their future. There was no brokerage company out there that was focused on solely the average Joe out there. So why do investors choose Vanguard? Because they were the originator of mutual funds as well as the index fund. Prior to the creation of the mutual fund, most investors just had the ability to buy stocks or bonds individually, or potentially have an actual investment advisor make these decisions on their behalf. So they pioneered the mutual fund, and they also pioneered index funds, because prior to that, mutual funds were the only option available, and mutual funds aren't cheap, or at least they weren't cheap. They had expense ratios, and we'll talk more about expense ratios later in this video. But when Vanguard created the very first index fund, they said it's better to just match the market than try to beat the market, because most portfolios that try to beat the market don't do it. And if they do it, maybe one year, data has shown that most active fund managers are not able to beat the market continuously year over year. Another reason to choose Vanguard is their unique structure, because they are a client-owned company. What does that mean? The actual investments of Vanguard are owned by its individual shareholders. So if you invest in a Vanguard index fund or a Vanguard mutual fund, you are a part owner in Vanguard. They're not a publicly traded company. The only investment company owned by people like you. We don't need to worry about our stock price or generating profit for private owners. Our 30 million investors own the funds that own the company. I liken this idea to the difference between credit unions and banks. Both credit unions and banks offer very similar products: auto loans, checking accounts, savings accounts, mortgages, etc. The big difference between credit unions and banks is their profit motive. Banks, at their core, are a for-profit company, meaning that yes, they're offering services and they're trying to create value for their clients, but at the end of the day, they are publicly traded companies that have shareholders, that have investors that want to make money. That means at the end of the day, if they have to choose between making money and keeping their clients happy, they're going to choose making money. Whereas credit unions are not for profit. They are owned by their members. And so as a result, they're able to offer lower fees. And because that profit motive is gone, they can offer a better experience for their customers. Same thing here with Vanguard. Fidelity Investments has great products, but at the end of the day, they are a privately owned company. They are held by FMR LLC, which is controlled by the Johnson family. The family, along with a small group of FMR employees and shareholders, are also investors and blah, 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 blah. Point is, it's owned by specific individuals, not their collective investors in the company. Not the collective group of people that invest in the funds that Fidelity offers. That's what Vanguard's product is. And then if we look here at BlackRock is publicly traded. Charles Schwab is publicly traded. These companies have a profit motive. Vanguard is different. They are owned by their shareholders, kind of like a credit union. And Vanguard's mission is stated really clear right here. to take a stand for all investors, to treat them fairly, and to give them the best chance for investment success. Vanguard also has a history of strong performance here. You can see here that any fund family is only as strong as its fund performance, and 86% of our funds have outperformed better than their peer group averages over the last 10 years. Additionally, Vanguard has lower fees on average than most brokerages out there. Now, I will be fair and say that there are some fidelity funds that have lower expense ratios. I'm going to admit that right now. But like I just mentioned here, Vanguard not only has low fees, they also have a different value proposition with respect to investing in a company that's owned by its shareholders. So expense ratios represent how much it costs to operate the mutual fund and the ETF. There is a cost associated with the benefits you get from an index fund or a mutual fund. The investment company that manages the funds has to be compensated for their fees and their expenses and just the work that they put in here. But not all expense ratios are created equal. We have some funds out there that charge an ultra low expense ratio, 0.015, 0.03, 0.04% of the money invested. Whereas you've got some companies that are charging 1%, 2% every year just to be invested in that fund, which is just heresy to me. It's ridiculous. As it says right here, for example, the average expense ratio across the entire fund industry, excluding Vanguard, was 0.57% in 2019, which means that for every $10,000 invested, they're going to charge you $57 in fees every single year, no matter the performance of the fund. The fund increases 20%, you get the $57 fee. It goes down 30%, same fee. However, compare that with Vanguard, where the average fee for all of the mutual funds and ETFs was 0.10%, or just $10 versus $57. That's 83% lower than the industry average. So when we talk about why you should choose Vanguard investments, well, number one, their investments are coming from a company that's owned by its shareholders. They don't have an underlying profit motive when it comes to the company doing well. The company does well when its shareholders do well. Additionally, they have lower expense ratios. We just talked about that. And as we're going to talk about in this video, they have great investment products that are going to benefit you financially. Let's talk a little bit about the different types of accounts that Vanguard offers. If you want to invest in Vanguard investments, you don't have to use a Vanguard account, but you certainly can, and they offer quite a few different accounts here. So we've got IRAs, an individual retirement account. You can also own a Roth IRA account with Vanguard. They also offer individual and joint accounts. These are also known as brokerage accounts or taxable accounts. You can own the exact same investments in an IRA or Roth IRA versus a taxable account. The difference is the tax preferential treatment. If you're investing in an IRA or a Roth IRA, that money is going to be put towards your future retirement and not be utilized right now. Whereas with a brokerage account or taxable account, you would utilize those if you have a need for the money sooner than retirement. Also, for small business owners, they offer a SEP IRA, which is known as a simplified employee pension. You can also own an individual 401k. If you're looking to invest for your child's education, you have the ability to invest in a 529 plan. And there are tax benefits associated with 529 accounts. You can also own an UGMA or an UGMA or an UTMA account, as the people like to call them, Uniform Gifts to Minors Act or Uniform Transfers to Minors Act, which allows you to open an account where it is owned by the minor, but it is managed by you until they turn 18 years old. As soon as they turn 18, it's automatically their investments, their assets. Let's talk a little bit about Vanguard investment products here. That's really the core, the focus of this video. Vanguard offers 3 different types of products primarily. They offer a few actively traded mutual funds. We'll talk more about that. They offer indexed mutual funds, and they offer exchange traded funds, also known as ETFs. Let's talk about the differences between a mutual fund and an exchange traded fund, because even though the actual underlying assets are the same, the way that these products trade are different. So as you can see here, you may be surprised by just how similar ETFs and mutual funds really are. Both mutual funds and exchange traded funds are a collection of investments, stocks or bonds or both together, a way for you to automatically diversify your assets. Depending on your strategy and how much knowledge you have, you can certainly be successful buying, owning, and selling individual stocks. That's not the point of this video. With Vanguard, they offer the average Joe the ability to diversify your assets. when you diversify, you have a collection of different assets available. So if you buy one stock, the risk is that stock could go down in value if you picked the wrong stocks. However, if you own lots of different stocks, if you're buying the market, or if you're having a fund manager invest on your behalf, there's a lower risk of you losing money. Both mutual funds and exchange traded funds, like I said, are collections of assets. They are both less risky than owning individual stocks and bonds, as it mentions here. There's built-in diversification. One individual fund could include tens, hundreds, or even thousands of individual stocks or bonds in a single fund. So if one stock or bond is doing poorly, there's a chance that another is doing well. This helps you reduce risk. Now, additionally, both of them offer a variety of investment options with Vanguard. They give you access to a wide variety of US and international stocks and bonds. So if you want to only invest in stocks, you can do that with Vanguard, with an index fund, a mutual fund, or an ETF. If you want to invest in bonds, you can do that. If you want to balance between the two, you can do that as well. You can invest in just a few hundred companies. You can invest in thousands of companies in one fund, depending on what your strategy is. As it says here, Vanguard offers 75 different ETFs and 160 different mutual funds. Now, both exchange traded funds and mutual funds are managed by experts. Those experts choose and monitor the stocks or bonds that funds invest in, saving you time and effort, right? So if you're buying a fund, that means you are passing on that time expense, the research, and actively buying the different assets. You're passing that on to somebody else to manage on your behalf. If you own individual stocks and bonds, you've got to do that yourself. So both ETFs and mutual funds are managed by professional portfolio managers with Vanguard. And like it says here, both ETFs and Vanguard mutual funds can be bought and sold online in your Vanguard brokerage account without paying any commission ever. And with the growing trend across the entire investing industry, oftentimes you can invest in a different brokerage with Vanguard investment options for free. We'll talk more about that later. So now you understand why they're very similar, mutual funds and ETFs, but how are they different? So it all comes down to how they trade, and there are some specifics with respect to Vanguard as well. The biggest difference between mutual funds and ETFs comes down to how they are purchased and sold. So with a mutual fund, you are investing directly with the brokerage company. Let's say you want to buy the Vanguard 500 Index Fund Admiral shares. Ticker symbol there is VFIAX. And so you're looking down here, you can see that the price of the fund is $353.09. And you think, I want to buy the fund right now, 9:30 in the morning, because I like the price of the fund. Well, truth is, no matter what time you buy it on that day, you are not going to get that price per share, no matter what time you buy it. Because the way that a mutual fund works is all new investors buy at the end of the day. So what happens is it trades throughout the day. People buy new shares of the fund, people sell shares, and at the end of the day, Vanguard is going to reconcile all the different people that wanted to buy, all the different people that wanted to sell, and they'll have a final price for the day. And that is the price you're gonna get no matter what time you buy. So if the market were to go really far down midday and then really far up, whatever that ending price is the price that the new investor is going to get, no matter what time you buy during the day. It's different for a Vanguard exchange traded fund. Let me pull this back up here on the screen for you. If you want more hands-on control over the price of your trade, an ETF could be a suitable investment. Not only do exchange traded funds provide real-time pricing, they also let you use more sophisticated order types that give you the most control over your price. Whereas it says here, a mutual fund would not be a suitable investment in that situation. Regardless of what time of day you place your order, you'll get the same price as everyone else who bought and sold that day. That price isn't calculated until after the trading day is over. And that's not necessarily a problem. You don't need to focus on that. For somebody who is trying to dollar cost average or just invest throughout the month, throughout the year over year, and not worried about the individual price day over day, then a mutual fund is not gonna be a big problem for you. But if you're really concerned about getting a specific price, then an ETF would work just as well. Now, some arguments against exchange traded funds are because they're so easy to invest in throughout the day, you can purchase it right at 9:30 at a specific price or right at 1:30 at the specific price. It makes it easier to trade them, which means you might overtrade them. And studies have shown that investors that actively trade are much more likely to have a lower balance at the end of their investing journey. Now, one thing that a mutual fund can do that an exchange traded fund cannot do is you can set up recurring transactions for a mutual fund. Let's say you want to invest on a recurring basis with that same Vanguard S&P 500 fund, VFIAX. So you can set that up to where it can automatically draft out of your bank account $500 or $1,000 every month, every 2 weeks, whatever you want to, and it just becomes clockwork. It's automatic investing. It's a little bit more difficult with an exchange traded fund. You have to physically buy the fund every time, which is not a problem either. But if you're looking for the most simplistic way of doing it and you want to make sure that you're investing on a recurring basis, then a Vanguard mutual fund is going to be a better option for you. Another big difference between Vanguard mutual funds versus Vanguard exchange traded funds is the investing minimums. So all of Vanguard's mutual funds, with the exception of their target date funds, which we'll talk about, have an investing minimum of $3,000, meaning that you can't invest in the fund at all until you have at least an initial $3,000. Now, once you meet that minimum threshold and you buy the fund, any future investments in that index fund or mutual fund can be done as low as for $1, but you have to meet the minimum $3,000 threshold. Whereas with an exchange traded fund, and I'll show you this on the screen here soon, you can buy the exact same fund, the same underlying assets, but you can do it for the price of one share. So $3,000 versus $150 or $200 or $300. So it can be a lot easier with a Vanguard exchange traded fund to get started investing. Additionally, it can be cumbersome cost-wise to buy Vanguard mutual funds from a different brokerage. So if you have your investments or your accounts at Fidelity or Schwab, they're going to charge you a fee to buy Vanguard mutual funds. And that fee can be as high as $50 or $75 for every trade. That can be really expensive over time. Whereas if you have your accounts with any other brokerage, whether it's Robinhood or Webull or M1 Finance, Fidelity, Schwab, doesn't matter, you can buy Vanguard exchange traded funds for free. Okay, so we know the difference between mutual funds and exchange traded funds. Let's talk briefly here about Vanguard actively managed mutual funds versus Vanguard index funds. So an actively managed fund and an index fund are different for one specific reason. An actively managed fund is trying to beat the overall market, provide better returns than just investing in, let's say, the Dow Jones Industrial Average or the S&P 500 index, the 500 of the largest companies in the United States, trying to beat the overall market. And to do that, they employ an active fund manager who is actively making buy and sell decisions on your behalf. They don't ask you for your recommendations. They don't ask you for your research. They don't ask you if it's okay to do something. They're just going to make changes in the portfolio that they deem best. Some actively managed funds can beat the market. Sometimes they can beat the market consecutively or 2 or 3 or 4 years in a row. But most studies have found that it's difficult for an active fund manager to beat the market consistently over a long period of time. And that's where index funds come in. With an index fund, you still have a portfolio manager, but they're not actively trying to beat the market. They're just simply trying to match the market, which means that if they're trying to model the S&P 500 index, which again is the 500 of the largest companies in the United States, think Apple, Microsoft, Amazon, Google, Facebook, Visa, MasterCard, companies like that. You're just trying to own the exact same investments that are in the S&P 500 at the same levels. Here's a little table here on Vanguard's website that differentiates between actively managed funds and indexed mutual funds. So we've got here the fact that an indexed mutual fund or ETF is trying to match the performance of a market or a specific benchmark as closely as possible, whereas the actively managed fund tries to outperform its benchmark right here. Strategy-wise, it buys all of the stocks or bonds in the index it's tracking. That's an index fund. Whereas with an actively traded fund, it uses the portfolio manager's deep research and expertise to hand select stocks or bonds for the fund. One of the realities of actively managed funds is they cost more money. They have higher expense ratios. And that's because the fund manager, in addition to paying that fund manager more money because they're actively trading, well, they're actively trading. And there are more transaction costs associated with that, buying and selling different stocks and bonds. And as a result, those higher expenses and sometimes the capital gains from selling too often on profits could lead to higher expenses that are passed on to you as the investor. So let's talk a little bit more about Vanguard indexed mutual funds. So they stand above the rest. They have an enviable cost advantage. They are generally going to be a lot cheaper to own from an expense ratio standpoint than any other types of investments out there. They can for consistent long-term returns. 82% of the indexed mutual funds and ETFs that Vanguard has offered perform better than their peer group averages over the last 10 years. And like it says here, Vanguard launched the very first index fund for individual investors in 1976. And they've been perfecting their benchmark selection and tracking skills every day since. And just to make sure we're on the exact same page here, what exactly is a Vanguard indexed mutual fund? An index fund. An indexed mutual fund, or ETF, tracks the performance of a specific market benchmark or index, like the S&P 500 index, as closely as possible. So instead of using the word active management, we're talking passive investment management with an index fund. Instead of hand selecting which stocks or bonds the fund will hold, the fund's manager buys all or a sample as closely as possible of the stocks or bonds in the index it tracks, because it's trying to match the index. This leads to lower risk, lower taxes because there's less trading, and lower costs overall. And in many cases, when we talk about exchange traded funds, and this is true for Vanguard specifically, most exchange traded funds are index funds in that they're tracking a specific index. So index mutual funds and ETFs, like I said, besides the fact that there are some differences in how the product trades, the underlying assets are going to be exactly the same. And I'll show you most cases where if you're looking at a specific indexed mutual fund, you can get the exact same assets as an ETF. So if you're on Vanguard's website, you can come up here to investing and you can go to investment products and we can look at Vanguard mutual funds. And this is we're gonna get to their Vanguard mutual fund screener, or their investment screener here. You can go to looking at a complete portfolio in one fund. You can review a short list of their Vanguard select funds, or what we're gonna do here is click on Browse Vanguard Funds by asset class. So we come here and it's going to give you a big list of all of their mutual funds. 131 different Vanguard mutual funds. From there you can filter out. You can see you've got columns here for the name of the fund, the ticker symbol, what asset class it is. We're looking at, bonds or stocks or cash. There's the expense ratio. We've got the price as of January 8th, the change in the last investing day, the SEC yield, which is their distribution yield, which is going to be interest or dividends earned. Then we've got their year-to-date performance and the 1, 5, 10-year returns, and since inception, and it will tell you when that fund was created down here. So there's money market funds in here. We're talking about mutual funds right now. We have US bond funds. They have balanced funds. Again, a balanced fund is when they invest in both stocks and bonds. And as part of that, they have their target retirement funds. So a target retirement fund is a mutual fund, and it is not indexed per se, but it is a combination of different Vanguard mutual funds. So the way that a target retirement fund works is you don't want to be hands-on with your investments, and you know that you want to retire in, let's say, 2040. Or 2055 or 2060, depending on your age and when you actually want to retire. And what these funds will do, if you buy the 2040 target retirement fund, it will, over time, change the assets in the fund to account for less risk in the portfolio. When you're younger, when you've got more time until retirement, you are able to take on more risk and take more bumps and bruises in the market as long as you are overall going up. And so as a result, in the 2040 fund right now, the portfolio is made up of mostly stocks and some bonds. But over time, as you get closer to that 2040 year, they're going to slowly move you out of stocks and into more bonds, which will increase the stability of your assets and avoid you from having too much exposure if there's a market downturn at the wrong time. A target retirement fund might be perfect for you if you want to be completely hands-off in the investing process. You love the idea of Vanguard, you love the idea of Vanguard investment products, and you just want to be hands-off and continue to buy the same fund month over month every year and not worry about investment allocation over time. These types of funds would work well. You'll see here that for the most part, the expense ratio is 0.13, 0.14, or 0.15%, meaning that for every $10,000 invested, the annual fee would be just $15. Not bad at all. And you can see here that over time, these funds have done really well. Some of them were launched in 2006, 2003, 2010, 2012. They all have done well over time. Additionally, Vanguard offers US stock funds, and you can break those US stock funds into large cap funds and small cap funds and medium cap funds. So lots of different mutual funds. Small cap meaning small capitalization, meaning companies that just are worth less money. They're smaller, they're still growing, versus mid cap, mid-sized capitalization funds, and large cap. So you might think of a small cap as a company that's really new and they're growing, whereas a large cap fund would be something like Apple, Google, Amazon, Facebook, large companies worth a lot of money, big companies. So what you can do when you're looking through all their different indexed or actively traded mutual funds is you can come up here to the top and go to their filter. And you can filter by, do you want to look at all asset classes, or do you want to just look at bonds or stocks or international stocks or sector specialties, which is an interesting idea. If you look at their sector specialties, you can invest in specific sectors of the economy. If you're going to take this method though, I highly recommend utilizing their ETFs, because if you're utilizing their mutual funds, number one, you're going to have higher expense ratios. And number two, a lot of times the minimum cost to own these funds, let me just show you here, the Energy Admiral shares, you can see the minimum cost here. The minimum initial investment is $50,000. Most average Joes out there don't have $50,000 to invest in the energy sector or the healthcare sector at one time. But if you flip over from mutual funds to ETFs and you go back to that screener here, and then you click on the filter and you go to all Vanguard ETFs and you want to go to sector specialty, you'll see that all of these ETFs can be owned for the price of just one share, as opposed to having a minimum of say $25 or $50 or even $100,000. So if you like the sector fund idea, sector ETFs, I would certainly recommend ETFs versus the mutual fund version of those investments. Through this filter, you can also select only US bonds. And within that, you can select from a high quality, medium, or low, or when they're going to mature. Are they short-term maturity, or are they going to be long-term investments? You can see there's 16 different ETFs you can own. You can own extended duration treasury ETFs, or you can also flip back over to mutual funds and see the mutual fund versions of those. Within this screener for mutual funds and ETFs, you can select US stocks, large, mid, small cap. You can also look if you're looking for specifically growth stocks or value, or a blend between the two, and then their fund minimums here. You can actively only look at active funds here, or you can select only index funds. So generally, like I said, I like to stay away from active funds. I'll unclick that change it from 42 to 17 matching funds. You go to index funds here, you can see all of Vanguard's US stock index funds. You can see here we've got the S&P 500 index fund. We've got dividend appreciation index funds. We've got growth, we've got high dividend yields, large cap, and you can see here there's differences between the expense ratios. You can filter by the expense ratios. If you're looking for the lowest ones here, you got 0.04%. The total stock market versus the S&P 500. We already know what the S&P 500 index is. The total stock market is just that, the entire stock market. All of the big, small, medium-sized companies here in the United States. Furthermore, you can sort by how they've performed year to date. Now, there's only been like 3 or 4 trading days, so you're not gonna see big numbers here, but you can see the average annualized returns as of December 31st. So the 1-year return, you can see that the highest performing fund was the Growth Index Admiral shares. 40.19% return last year, which is a lot better than the S&P 500, which returned only about 18%. Actually, yeah, 18.37%. If you're looking for long-term, which form has performed the best over the past 5 years, you can see here it was the Growth Index Admiral shares, 20.32%, same fund. How about the 10-year return? Same one, Growth Index Admiral shares, 16.67%. So what you ultimately decide to do here is going to be up to you. You can choose Vanguard mutual funds, you can choose Vanguard exchange traded funds. I myself prefer ETFs because I don't have a brokerage account or a retirement account directly with Vanguard. Their platform is a little bit aged for me, but I own Vanguard ETFs. I just own them with a different brokerage account, and I can do that for free. I happen to do that in my M1 Finance account, which I'm actually in the process of moving over to a new brokerage. But you can own it with Schwab, Fidelity, Webull, Robinhood, all these different companies. You can purchase Vanguard ETFs completely for free. And in many cases, you can click over here and you can see the differences between the two. In many cases, if you want to own, let me go back here to mutual funds. And if I were to select, let's say, the S&P 500 mutual fund, there will be a link here on their website to tell you, hey, if you want to, you could also purchase the exact same assets here. It's also available as an ETF, starting at the price of 1 share, because remember, with Vanguard mutual funds, they have a minimum investment, $3,000 in most cases. But if you click over to the ETF, exact same fund, exact same assets, exact same performance, but the minimum cost is just one share, $350. And in many cases, if you want to go to other brokerages and own them in M1 Finance or Webull or Robinhood, you can buy partial shares of this ETF. You don't even have to have $350. If you have $100, they'll buy $100 worth of this fund. So you'll own, let's say, 0.33 shares of the Vanguard S&P 500 ETF. The same types of funds in Vanguard can be purchased as mutual funds or as ETFs in many cases. And I've also found that there are more opportunities for ETFs than there are for mutual funds. Let me show you what I mean by that. Yes, Vanguard does have a lot of mutual funds, but they have even a lot more ETFs here. Just looking at their stock ETFs here, you've got dividend appreciation ETFs, large cap ETFs, the mega cap growth ETF I own in my own portfolio. If you look at this one here, and any different option available, you can click on the investment and you can look at their overview, you can see their expense ratio, you can see their price and performance, and what's in the underlying index. If we go down here to the Vanguard Mega Cap Growth ETF, it seeks to track the performance of a benchmark index that measures the investment return of the largest capitalization growth stocks in the United States. So if we come down here, it's got 100 different stocks in the ETF. It's heavily weighted in technology, industrials, and consumer discretionary. Scroll down further, you can see the largest companies, the top 10 holdings: Apple, Microsoft, Amazon, Google, Facebook, Tesla, Visa, Nvidia, MasterCard, Home Depot. Those 10 holdings represent 56.2% of the total assets. Because remember, with Vanguard Index Funds and mutual funds, they are market capitalization weighted, meaning that the largest companies in the index, think Apple, Microsoft, Google, they get the largest weighting in the index. More money will be going into those companies versus some of the smaller companies. And with Vanguard's website, you have the ability to go and look at the actual holdings as well as the weighting. So the top 10 holdings with weighting, you can see that Apple represents 12% or 12.6, Microsoft 11, Amazon 9.3, Tesla at 2.9%. You even have the option to look at the actual holdings in here. So if you scroll down and you go to portfolio holdings right here, it'll show you all the different holdings from largest to small. So market value here, they'll show you biggest holdings are Apple at $1.2 billion, $1 billion in Microsoft. Smallest holdings, $2.3 million in Sirius XM holdings. Keurig Dr. Pepper represents $5.7 million. So I own the Vanguard Mega Cap Growth ETF. I also own the S&P 500. So if you're looking for a very basic all-in-one fund, two great options for you would be the S&P 500 and the total market. Very basic, cover a lot of different stocks. You're going to match the market. You're going to grow over time your investments. So if you're looking at the S&P 500 ETF, VOO, we can see here that it tracks the S&P 500 index. And if you look at the underlying performance and expense ratio is 0.03%, the price and performance here, we can look and see that historically this fund, which costs currently $350.42, last price as of January 10th. And we go down here, we can see that $10,000 invested 10 years ago would now be worth over $35,000. And we can see here, if we were to add a benchmark, the S&P 500, it's going to match it. It's almost perfectly aligned here. It matches the index. We can see here average annual returns. The 1-year return, 18.4%. 3-year return, 14% on average every year. 5-year return on average every year, 15%. 13% 10-year, and since inception in 2010, 15.03%. And then we also have the Vanguard ETF for the total stock market. Let's go ahead and find that here. Total stock market is VTI. This one tracks all of the companies in the United States, large, mid cap, and small cap. Same expense ratio, 0.03%, which is ultra low. And we can see here, if we look at their portfolio, we'll notice that the number of stocks is much higher. Instead of 505 holdings in VOO, which is the S&P 500, we've got for the total stock market 3,586 different stocks. Now you might be thinking you get a lot more diversification with this one, but the truth is, just like the S&P 500, it is market capitalization weighted, meaning that the largest companies get the highest weighting, which means the same types of companies as the S&P 500 are going to hold the largest weightings. You see Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Tesla, Johnson & Johnson. The top 10 holdings hold 23.10% of the total assets. And if we look at the weightings, it's going to be very similar to the S&P 500. 4.4, 3.7, 2.8% in the top 4 here. So very similar holdings. You do get a little extra diversification with the total stock market. So either one of these are great investments. The total stock market ETF is VTI. Great opportunity. You can also own it as a mutual fund. The Admiral shares here. That is the Vanguard Total Stock Market Index Fund Admiral Shares VTSAX, also known as VTSAX. Same thing with the S&P 500, ticker symbol VOO. If you want to own it as a mutual fund, you can do that. We click over here to the Admiral Shares Mutual Fund version, VFIAX. But remember, every mutual fund with Vanguard has the $3,000 minimum with the exception of their target date funds. So every investor is going to be different here, guys. If you've got a lot of time to invest before you need the money, then I highly recommend looking at the S&P 500 or the total stock market and parking all of your money there. If you want to be hands-off, then the target date funds can be a great opportunity for you, though you will have a little bit higher expense ratios. But again, it's hands-off. You don't have to remind yourself to change your asset allocations over time if you really want to protect your assets as you get closer to retirement. If you want to get a little bit more fancy, you can look at their mega cap growth. You can look at their individual bond funds. There's lots of different options with Vanguard. And remember, any investment with Vanguard is going to be a better investment option knowing that Vanguard as an underlying platform is an investor-owned company. If you own shares in Vanguard, then you own Vanguard, which is a great thing to know. Hopefully you found some value out of this video, guys. Make sure to leave your 2 cents in the comments below. Did you learn something new about Vanguard? Which Vanguard index funds or exchange traded funds or even actively traded funds do you own in your own portfolio? Which ones are you looking to buy based on this video? Make sure to leave your 2 cents in the comments below. If you haven't done it yet, make sure to hit that subscribe button to see more videos like this one. We talk about index funds, Vanguard, Fidelity. We talk about my Fidelity dividend portfolio. And we also talk about all things personal finance that affect people like you and me, the average Joe. That's all I got for you guys. Have a great rest of your day. And please continue to stay healthy, both physically and financially. Have a good one.